Reserve cut its benchmark lending rate by a quarter point to a new range of 4% to 4.25%.
Yeah, and this marks the first rate cut of the year, and it comes at a critical moment. It is happening amid President Trump's ongoing trade war, rising inflation, and consumer prices that continue to climb. Meanwhile, the nation is facing its highest unemployment rate in 4 years.
KSL Financial contributor Spencer Nelson joins us to break down what this can mean for you. Thanks for jumping through the screen with us, Spencer, today. In terms of the size of the cut, can we start there? Does this feel significant to you in this climate?
You know, it really doesn't mark a significant amount in terms of a rate cut. A 25 basis point cut isn't a huge change. What really is a big deal is the trajectory in which the Fed has kind of shifted positions from no rate cuts to now doing 25 basis points. And they also are looking at probably doing another 2 interest rate cuts on the year, which would be 75 basis points. And that is significant. So the trajectory is probably the most significant thing here.
And when we look at the labor market, how is this going to help? Because we've seen the last couple of employment numbers and they're pretty dismal.
Yeah, so jobs numbers have had to be revised from 2024 and into 2025. And so I think the Fed is saying we are seeing the economy soften. They were worried about inflation with tariffs, and I think they've said that no longer is the largest concern that we have, but the softening and the revision of those jobs numbers show a different economy, or that we could be heading towards a different economy. And so they're trying to get ahead of that. By lowering interest rates, it obviously frees up money. The cost to borrow lowers, and so companies, individuals will have less expense to have their money, which encourages the flow of capital. And that hopefully will strengthen the job market and increase companies wanting to hire.
And in conclusion, how do you see the impact on the ground? Like, numbers are just numbers, right, until they affect our actual budget. Where might we see the biggest impact on consumer spending? And do you think it could offer overall some financial relief for families?
Yeah, great question. So it affects people on 2 sides, right? The savers are going to be a little more unhappy because the interest that they're getting on their high yield savings accounts or money market accounts or treasuries, that's going down. And so we're penalizing them a little bit. However, those that are borrowers, specifically credit cards, personal loans, HELOCs, and auto loans, those are directly impacted by the Fed funds rate. And so the borrowing cost is going to go down. So those that are in debt and having to pay interest on those debts, it's going to be a little softer for them and not be as punitive. Mortgage rates do tend to follow as well. You've seen mortgage rates ahead of time start to come down. I think you'll see that continue.
Good to note. And thank you for your insight. Great job, Spencer. We appreciate it.
Yeah, thanks so much.